Hello and welcome to Global Mantra Outlook 2014, a special show that profiles prominent fund managers and global market speakers from the City of London and gets their views on the global market environment. Joining me on the show today is Sean Taylor, who's the head of emerging market equities at Deutsche Asset Management. Sean and his team manage close to $9 billion in assets. Sean, great to have you on the show. Thanks very much.
Thank you for being invited.
Let's begin by understanding your outlook for emerging markets in 2014. This year has been a bit of a washout, really, so to speak, for emerging markets. Do you think that we are looking at emerging markets doing some sort of a catch-up to the rally that we've seen in developed markets so far?
It's been a very difficult year for emerging markets, and it's also been quite a volatile year. Looking forward to 2014, we think that emerging markets will perform better. We think Asia will perform better than emerging markets. But for the first half of the year, we could still see other global markets outperforming them.
What do you think would change in the second half that could bring about a rally? So you're essentially saying the rally would come in post-June.
Essentially, I think the real key to emerging markets outperforming global markets has got to be, from an emerging market perspective, earnings growth. And we're forecasting a 9% earnings growth. The market's forecasting 11%. But I think we need to see an inflection point where we start to see analysts upgrading that growth. We think that on a macro basis there's a much better environment for emerging markets next year, that a lot of the significant countries are growing slightly quicker, and that's very good for corporate profits. Do
you think the downgrades have stopped or are pretty much done on earnings as well as GDP growth?
I still think there's some more downgrades to go in emerging markets. I mean, we started off this year with consensus forecasts of about 17. We're now down to about 11, and I expect we'll get down to about 6 by the end of the year, the reality, reflecting the macro. I think this year, analyst expectations, the market, the street itself, is a much more realistic, but I still think it's too high. Where the real differential last year was in earnings has really been in EMEA, Europe, Middle East and Africa, and it's been in markets which have had quite big currency swings, so South Africa, Turkey, Central and Eastern Europe. So I think, and also obviously affected by the commodities. So I think next year we're starting off more realistic, with less chance of downgrades, but I still think the momentum's there. But to make emerging markets in Asia look much more attractive to developed markets, we've got to also see the other side of the equation. So this year we've had Japan being upgraded, Europe being upgraded, and US earnings being upgraded, and on the other hand, and so we need to see either them stopping being upgraded, or we need to see them being downgraded.
Yeah, this year has seen a lot of inflows in ETF products versus mutual fund products, as the data suggests. Do you think that could change in 2014, that there'd be a lot of interest in long-only money which will chase growth rather than chase yield, which is what's been happening so far?
I think the trend's been around for the last 3 years, actually, for the ETFs, which has been building up. I don't think it changes in the first half of next year, because I think we have the risks of tapering. I think going forward, clearly it will change, because those houses or firms that can produce much better differentiation in their products in terms of countries will benefit and will beat the index. When we talk about emerging markets in Asia, we're talking about a very generic area. But I think what's the key message from us is that it's not homogeneous. India is very different to Thailand. Japan's now on the investment map is very different to China. Russia's very different to Turkey. And I think with what ETF does, they basically assume that's all one trade. And I think what we're finding now, clearly, given what's happening in the US, that clearly with the potential for rates going up, that going to have a huge differentiation in markets, within regions.
The other part about this whole EM story will be the currency risk from a foreign investor perspective. So how are you looking at that risk right now?
The currencies that are most at risk are the current account deficit currencies. Okay, so actually, if tapering happens in the US dollar, Japan will actually benefit, Korea will actually benefit. China is good news. There's other countries.
What about India? Because we've taken measures, the central banker has taken.
Yeah, I mean, India's a sort of slightly different situation, but in terms of those currencies, I think what we have to point out is that the emerging market debt index is much more related to those riskier currencies than the equity index. Does that make sense?
Yeah.
Yeah. So a lot of people. So as an emerging market investor running Asian portfolios, running an emerging market portfolios, or running smaller emerging market portfolios, we can allocate out to the less risky markets and avoid the smaller markets. Okay. We can't ignore India though, because it's too big in all the indexes. India clearly, dollar up is not friendly for the rupee. But I think the new central bank governor and the policy that's come in, where we're trying to target, to keep the currency tight by putting rates up, but also by providing liquidity, is a very different policy than that's happened before. Because ultimately, India needs growth. Yeah.
That's fair, but rates have been going up in India, in order to stabilize the currency.
Yeah.
You've highlighted, we've been keeping a fairly liquidity-savvy environment.
Yeah.
The point is, despite all these measures, would that make the currency weaker than where it is right now, which is 62, 64 whereabouts?
I think it would, yes, but not dramatically weaker, because I think there are two things in its favour. Firstly, we've got, I think it's going to be range bound, but firstly we've got a narrower current account deficit. There's been more money that's come in from abroad, and secondly, I think there's more reserves now to deal with it.
How are you viewing the India story? You have a neutral rating on India.
We have a neutral on India. Yeah. I mean, for foreign perspective, India is quite a difficult market to read at the moment, because we believe that the real driver going forward is going to be the election cycle. And that can give, if there's a very positive election cycle that Modi is going forward, then that could be very, very positive for the market, or that's what the market's sort of believing at the moment. And then that's obviously quite positive, maybe potentially for investment. And I expect that if that momentum gets in the market will run. Now, whether the actual reality comes in with that is not to say.
Is the view hinging on which party comes to power, or is it just about having a stable government at the centre?
I think it's about hope that the next government, whoever's in, will change things for the better for the economy. That things have got quite bad for the economy, and that and it's very similar to the way I look at Brazil. It's India has been has been disappointing on the growth front and surprising on the upside on the inflation front, which I expect you'll agree with. Yeah, it's the same way as Brazil, and that could continue with the same situation. There is no reason why that doesn't continue going forward, and that's not very good for equities. Okay, and so when you get hit by things like tapering, the currency weakens. When tapering's over and you raise more money, the currency strengthens. But we still haven't got over that trap of lower growth and higher inflation. Yeah, which is obviously not positive.
Do you think that could change in the coming year?
I think,
given all the measures taken.
I think people hope it could. But both governments, both in India and in Brazil, who get elected, are going to have to, really show the market that it can change.
But the government has, and the central bank in the last 6 months have done a fair amount to kind of bring about a change in perception on the policy front.
And I think the market's rewarding it for it.
Okay.
Yeah, and I think
that's why you think the Indian markets hit record highs? Was it driven by liquidity, or was it driven by conviction that maybe things could potentially change from here? The rally that we saw in the markets recently. I
think it was driven by some foreign money coming in, using the weaker rupee as an opportunity. I think India's always been an expensive market relative to the rest of the world for foreigners. I think that the problem, from a foreign perspective, the real issue with India is the macroeconomic policy and not the company level. I think investors, if you look at China's got great macroeconomic policy, but doesn't have the quality of the companies versus India. So I think people are always looking for long-term entry points into India. And look, potentially, this could be a change. Elections in India have been elections in India have potentially caused a catalyst for change. And I think the market's prepared to do that.
So any change in view from your house would only happen post-elections, is what you're saying?
A change in view.
Because right now you're neutral. So what would make you change that stance or go overweight in India? And would that be post-elections?
No, not at all. I mean, we've had a very, very good run-up, which we've captured quite well. So, we feel it's neutral. I mean, look, on a when we drill down on a sector basis, we're not yet, where's the value? It's in the state banks. Yeah? The fundamentals of the state banks aren't as good as the fundamentals of the private banks. Yeah? Some of the private banks are quite expensive. So, we've got to be wary on that. And they've had a good run. And the mid-sized private banks are a reasonable value. But they have had a very good run from the bottom. We really like the IT sector. That's obviously benefited from lower currency, plus from what's happening in the globe. And we still think that, the next couple of quarters will be very positive on earnings from that. But they have run. Yeah. And it's also relative to other markets. I mean, India's had quite a run over 2 months relative to other markets. Yeah. I mean, in our Indian portfolios, we're fully invested. And, in the same weightings. So,
my specific question is, what does the election risk do for your overall view in India?
We look at everything in relativity as well, if that makes sense. So, when we're running Indian portfolios, that has a pure Indian view, but our Indian neutral has come from an underweight, is relative to, having done well, is relative to what happened to other markets, if that makes sense, yeah?
Yeah. But do you think that post-elections you would be kind of reassessing your view on India? That's just.
I think if
would you be increasing allocations?
Oh no, without.
Would it be defining your view on the long-term future? Because then the government stays on for the next 5 years.
Yeah, of course it will, and we'll be looking very much into the detail. But I expect the roadmap is probably slightly different to that. I expect the roadmap is, if the momentum gets positive in the market, and let's face it, foreigners are buying it, you've seen the flows in, locals aren't buying it, the flows are going out. If that continues, I expect we will more likely to be overweight India into the election, okay, than after the election. Because if we get this, it's a bit like what you just said back to the US market and the European market. They've run, but the fundamentals haven't necessarily come through. You could quite easily get a hope rally in India, which could quite easily be 20-25%.
From here?
From here, yeah. If into next May, if the election, if people get positive and the global environment is fine, yeah. But let's say you did get a 20% rally at some point beginning next year, once people have digested the elections, the state elections. That would make India reasonably expensive, and would give the market would need a lot of the new government coming in would be joining. Would have to deliver on everything. So I expect you would get some sort of positive momentum into the market, into the election, and then I expect there'll be a pause, and people will take profits and actually see what the actual reality is.
So there would be an adjustment period, you're saying, post.
Oh, I think definitely, yeah.
To see whether the new
there has to be.
delivers.
We don't know. We know. Fund managers and markets deal with facts, and uncertainty, And I think where there's a huge difference in the markets at the moment, it's a bit like, let's talk about China reform, Mexican reform, and India's going to be in the same situation. Mexico's got this fantastic reform process planned, which is hopefully going to lead to 5.5% GDP growth from 2.5 in 2-3 years' time. But the first quarter the last quarter was negative, was lower than market expectations. So people sold the market off. To put in proper reforms takes a long time.
Okay.
Yeah.
I have a couple of more questions in India. Specifically on growth. What do you? Do you think we've hit a bottom? You think 4.5-5% is pretty much the bottom?
I think we've hit a bottom. Yeah.
You think this year would be 4.5-5%?
Look, the two. What are the two biggest variables in that? Yeah. If the currency is roughly stable, forget the actual effect of tapering, which obviously would put it up. If the central bank keeps the currency relatively stable, I expect growth somewhere at the bottom. Okay, and I think the oil price will probably be in favour of India.
Gold and oil both will be subdued in 2014.
Yeah. A $10 change in the oil price down. I mean, we're expecting a reasonably strong, a reasonably good oil price. Yeah, but it certainly has a premium in it because of Iran at the moment. So a lower oil price would be quite positive for India.
So you expect a favourable CAD situation for India into the coming year?
Yeah, more improving.
Improving. That's the trajectory. Okay. Rates. We've seen rates go up a bit. Do you think we're done with the rate hikes in India, or there's still a bit more to come?
I would say there's a bit more to go.
Okay.
Yeah, but it's going to be very data dependent. I expect the magnitude's there already.
What about inflation? How do you expect?
Well, the last inflation number was in line, wasn't it? So if that trend continues, I think we'll see the status quo and maybe 50 basis points up.
Do you expect inflation to cool off over a period of time?
I think it will stay steady for a bit.
For a bit. Okay.
Yeah. I think we need to see really. I mean, the inflation number that came out the other day was at 7.1. It was quite in line, with consensus, market expectations. I still think there's probably a little bit of a risk of the weakness of the currency since May. So
stepping into elections, you see more rate hikes?
I think it'll be very. I mean, it's obviously harder to put. It's obviously harder for rates to go up into the election cycle. I think it's data dependent. I really do.
And in lieu of that, you don't see a further impact on growth. It's not like
I think the most important thing is the confidence in the economy, and the liquidity is still there.
And in terms of themes that are playing out, not just for India but for emerging markets, and the consumer theme has really played itself out quite a bit, right? But cyclicals is the tricky part. So in India, you've had infrastructure companies which are trading at 5-year lows when it comes to price to book, right? Engineering companies are trading that low. There are resources and mining companies, Coal India, where the price to book is fairly cheap. Energy companies which are looking a bit favourable. I mean, Reliance is still hovering around the 900 mark. There are PSU banks which are looking extremely cheap, as you pointed out. Are these the stocks which emerge in that rally that you're talking about? Is money going to be chasing value in India?
I don't think. I think at the margin people will look to take on more risk in that rally because you can't get. I would have thought that the mid-cap banks would probably do the best. The private banks. I mean, there's some obviously the HDFCs etc. are very expensive, but I expect it's more in the ICICIs and the Axis and the Yeses and but people looking to try and take more specific risk. I mean, Larsen & Toubro's last results were pretty positive. I think the cyclical side of India is very different from the cyclical side elsewhere because it relies on also new orders. And we haven't seen that many new orders come through. That would be people would be buying them in the hope that a new government put more investment in and new orders. I think you've already seen that already in some of the Adani stocks. The reports have done quite well. Quite on the consumer side elsewhere, I think it's a very different equation. I think clearly rates coming up everywhere, slightly, and the consumer has been growing quite quickly, and consumer stocks are quite expensive. I expect the long-term trend is really, really supportive, but except in the short term, people are prepared to look at cyclicals. If you are getting better global growth, then yes, we would look more for cyclicals.
Metals, commodities.
I mean, more in global trade. Korean shipping companies and companies. The commodity companies. I mean, commodities are reasonably supportive. So well-run commodities like companies like BHP, Rio steel companies. We're quite positive on Brazilian steel. We're quite positive on Korean steel.
What about integrated steel opportunities in India, like a Tata Steel? What about opportunities which are export dependent or are primarily being led by inorganic moves like Tata Motors? What happens to these stories?
I think Tata Motors is an extremely good structural story that is a core in people's portfolios. I mean, it's one of the really good winners in India. I expect if you do see more hope from the election, then I expect some of the other car companies which are more domestic orientated, especially maybe ones that are sort of Maruti and Mahindra etc., which are more local domestic orientated would probably benefit as well. I don't think think people...
What happens to the SBIs and the PNBs, which are state-run banks, marquee state-run banks?
Well, I mean, I suppose, on the one hand, you have to look at them...
Because the opinion there is that, given the vulnerability they have to asset quality concerns, that they would be more of short-term, 3-month, 4-month trading plays rather than long-term structural stories like you pointed out, the HDFCs and the yes banks.
Yeah, I think that would be the case. I mean, I think you've got headwinds against them, that you've got rates going up and asset quality, and I think you've got a tailwind that they're extremely cheap in valuations and they're extremely cheap relative to other sectors. So people would take a chance. But at the end of the day, as they start to grow, you're going to need capital. A number of them are going to need capital, more capital.
Sean, before I wrap up, just one final summary of how you see 2014. Which are the top themes to your mind that will define 2014 for emerging markets? 2014,
we think, will be a much more positive year for emerging markets, and particularly for Asia. It will be probably more second half orientated, given the risks of tapering the first half. It is predicated on a slightly stronger global economy and more export growth. We don't really see too much of a PE premium coming up, but we see most of it being earnings driven. So we could easily get to a 9 to sort of 13% target on earnings and dividend alone without any premium or change in the PE. I think the real key next year is obviously going to be the risk factors of tapering or no tapering. Elections are going to be very key, but the overriding key will be, from a macro side, will be the differentiation in countries, and from a corporate side, identifying those companies that are picking up in earnings growth where they haven't been for a while, and we expect that to lead the asset class.
All right, Sean, we leave it at that. Thanks very much for taking out the time and speaking with us.